Hey, good morning, everyone. Good
Good morning,
morning.
Good morning,
Professor.
Professor. Good morning,
Morning,
Professor.
Hey,
Professor.
hey, good morning. Good morning, Devin. Good morning,
Good
Damien.
morning,
Good morning,
Professor.
Irina. Um,
How are you doing
good
today?
morning, Lewis. I see, okay, there are 8 people here currently. Let me quickly check how many are in the forum. And I see 11. So we're still waiting for the rest of the class to join us. And I believe it's gonna they're all gonna join us shortly. Um, well, since your midterm is in progress, uh, I'm gonna briefly uh, take you to the announcement where okay I have I have made announcement, two announcements yesterday, which is uh, uh, this went out actually 12 a.m. today, and this is not okay. Everyone knows, this is going to be out there on the 11th. Everyone knows, it's going to be. This is the last class before spring break, and the next class we will meet will be after the spring break, which will be on the April 23rd. And this is really a timing issue and logistics and timing. And um, the only way, I mean, just because it is spring break, then you think, I'm away from the books, I'm on vacation, blah blah. No, you can't let your mind on loose. You can't let your mind go loose like that. Okay, spring break is a time to um reorganize and reinforce. I mean, think about it as a battle during which you just have a little, let up, you know, a brief period of, ceasefire. And if it is a battle, what would you do? You would have to reinforce your troops. You would have to reinforce whatever is, lacking, ammunition, weapons, tactics, and, think of it as, that period, it's not a vacation. Okay. And otherwise, there's no way, I mean, whoever, there's no way we can cover this. So after the spring break, please read this. After the spring break, there's going to be the third midterm shortly. So please read this. I don't have time to go over this. But again, think of it think of it as a battle. I mean, so there is not a single moment you can let your mind loose. Okay. Um, so I would like to. We are almost done with the convexity, and last time I explained the theoretical basis for convexity. But then we need to do actual exercise. Another formula for convexity, which doesn't have to, for finding convexity, of course, it has, um, there's a non calculus way, non-calculus, the way that doesn't use calculus, and this is the formula for uh, a non-calculus way, the formula for convexity in non-calculus way. And again, the reason uh, we need convexity is reflecting the changing slope, right? And if we know the convexity, then we can derive this formula. In other words, this is what? This is the equation of the curve. This is the equation of the curve. And if you know the equation of the curve, right? If we know the equation of the curve, then we can predict change in bond price at any point, at any point. And by using duration, duration is only like this, a straight line. So obviously, uh, if the interest rate drops by 4%, right? 1, 2, 3, 4%, right? Predicting the price change by duration, it would only tell you, right? Oops. It would only tell you, the price change will be, 40 something percent. But actually, the price increase. But that's inaccurate because it's not precise. So precise measure will have to be, uh, based on the curve. So then if we know the equation of the curve, uh, then we can predict better. So if price drops 4%, 4 percentage point, right? The price will go up by about 70%, right? So that's a big difference, such a big difference. Um, so let's so here's a few little exercise problem. Um, the figure 11.5, I believe figure 11.5. This is figure 11.5, and based on that, maturity is 30 years, coupon rate 8%, interest rate or the yield to maturity 8%. Then the price of the bond would have to be exactly 1,000. It should be par value because the coupon rate and discount rate are the same. Now, if the modified duration is 11.26 years, now interpretation you should know by now. You don't have to wait 30 years to reap the most of the benefit of this bond. The benefit of this bond is 30-year bond is already all reaped. The benefit is already harvested by 11.26 years, right? And convexity, if we will need to verify this later because they threw convexity as this. And if convexity is given, we'll have to take the given convexity. Then what's going to be the price change? So using this formula, right, percentage of change in price, right, modified duration times change in interest rate plus 1 over, convexity over 2 times change in interest rate squared. And if you do that, we come to 18.27. Negative means, it's going to go down. It will have to go down because interest rate went up. So the price change will be 18.27%. If you predicted with only the duration, it's going to predict the price change of 22.52%. Price will go down by that. But price goes down. This change is in reality, let's say in reality, when when interest rate went up by 10%, price goes down to 11.46. And that's the drop of price by 18.85%. Now think about it. Which one is, which one is closer? Of course, convexity would give you more accurate forecast, right? And just by duration, there's a clear, gap, clear, inaccurate, imprecision in, in the forecast. Now, since there was a big change in interest rate, go back to, right? Uh, think about it. Interest rate goes up 10%. If it goes up 10%, we don't have, it's off scale here, right? Because it's going to be all the way out there. And then the drop in price would not be much lower than, look at the way it is curved, it's curved like this. So when the interest rate goes up, the price drop won't be as drastic as when the interest rate goes down. Because think about it, the curvature, okay, okay, you see what I'm talking about. So in other words, so this is bond price, right? Change in bond price. I didn't. This is percentage change in bond price, and this is percentage change in yield, right? So think about it. The curvature is like this. I didn't make. Again. Curvature is more like this. Okay, so if the curvature is like this, right, it would be symmetrical, right? It would be symmetrical. In other words, whether the interest rate goes down or goes up, the change in bond price will be symmetrical. But it is not symmetrical. It's not symmetrical. Therefore, the change in bond price with respect to a change in interest rate is not symmetrical. So this is when change is no change, right? And 1%, 2%, 3%. So think about it. 4, 5%. This is negative, right? Negative change, 3, 4, 5. So think about it. It is totally, asymmetrical. When interest rate drops, the benefit, which is, increase in price, that change in price is greater than the drop in, when interest rate goes up, right? The drop in price is much less than the increase in price for the same change in interest rate. Okay, it's because of this curvature, right? The way it is. So um, for a change like 10%, right? Uh, if the drop in price is 10%, think about it. That is, I mean, a drop in interest rate is 10%. Uh, the positive change or gain in bond price would be huge, whereas the same magnitude of change in, increase in interest rate, 10% increase, it would result in a relatively smaller change in bond price. Okay, relatively smaller drop in the bond price. So that's but if price changes like 0.1%, that's not 1%, 0.1%, very small change, 0.1%. Duration will do a good job, right? 0.1% change. Convexity would matter less because dropping price is, this is dropping price. And if we predict it by duration, it's going to be for 0.1% increase in yield, uh, the price change will be negative 1.126%, which is almost close to uh, the actual change in the bond price. If you predict it by convexity, it's got exactly 1.115% exact. But it doesn't really, that difference doesn't, it doesn't make that much difference, right? So think about it. In the in the bond market or interest rate in general, have you ever seen interest rate change as big as like 10%? No, if interest rate changes by like 10%, that would be a doomsday. I mean, if interest rate goes up, even by interest rate going up by 1.75%, and by the end of the year, you all know Federal Reserve has already taken a very firm stance against inflation. But I personally still believe it's too much. It's excessive. It's overreaction. Um, Raising interest rate by uh, uh, quarter percentage point each time, and six times a year, right? And 0.25 times 4 is 1. So 1.5 overall is going to be 1.5%. Yeah, that's already during this year. They're going to raise by the end of the year, and interest rate will, the Fed funds rate will be higher by 1.5%. I mean, of course, long-term rates will be almost higher by 1.5%. But even for that, even for 1.5% change, the market is, stock market is, fluctuating every day. It's fluctuating every day. And even, it's not something that was unpredicted at all. It's been predicted. So the market should not behave this irrationally, but it is the nature of the market. In the short run, market is irrational in the short run. Something that must have already been priced in. I mean, Fed has already made it clear since, about a month ago that they're going to raise interest rates 6 times this year alone, each time by a quarter percentage point. So then it's already predicted that by the end of the year, interest rate will be 1.5% higher. It's not unexpected. So all that should have been already priced in, right? It should have been priced into the stock price and the bond price. If the market is rational, but in the short run, market isn't rational. They, for every announcement made by the Fed, then panic again, slight recovery, panic again, slight recovery, panic again. Was this all necessary? No, it's not. It wasn't necessary. Most of this is partly because of panic, of course, because a lot of market participants are average Joe, average Jane. They behave irrationally. But the other part of this reaction is coming from the short sellers. The short sellers, day traders and short sellers, they want to make something anyway out of the falling, prices. The short sellers and day traders. And all that, variation or fluctuation in the market is partially due to those short sellers and day traders. Day traders are trying to make something no matter what, and day traders will also short sell too, because they sell high and buy low, later, that strategy. So you have to, but anyway, that brings us to the this exercise. So as the last, step, I want you to go back to, you have this bond exercise XL1, right? Okay. If you open that file, I believe you have this. This is the same file, I believe. So if you open this, right, we did immunization last time, exercise last time. Let's do the convexity exercise. And, you see, this is, convexity by calculus. And of course, I couldn't put the Taylor series expansion here. It's such a long, but this is the formula for convexity without calculus. So then let's try this. Everyone has this file in front of you.
Yes, Professor.
Okay. Or alternatively, you can open, chapter 11 convexity practice. But either way, it's fine. Either way, it's fine. All righty. So first, what you need to do is to use this, formula, right? Because you need, t squared plus t cash flow. This is discounted cash flow, right? We all know this is discounted cash flow. And then bond price, so first thing, if cash flow, I don't know if it is $3 or $30, but let's say $3 each time. It looks more like a 3% bond, right? Coupon rate 3%. So present value, we already know what to do. Coupon rate is 3%, so that must be $30, right? Yield to maturity, this. So all you need to do is this divided by 1 plus yield to maturity. This here, that's yield to maturity, right? I wonder, well, why doesn't it show this is when I named. There's a way you can name the range, you can name the variable. First, this is raised to 1, right? And then if you do that, you don't have to lock. You don't have to lock it. You'll just drag it down, and without locking the cell, it's gonna. And then t plus t squared, which is what? This is time plus time squared. And then you can drag it down. And then we multiply these two, find the product, right? Multiply these two. Okay, if you take the sum, right? Sum of these, the whole range. And also sum of, so I'll just copy this, paste it here. Okay, now think about it. What is this? What is the meaning of this sum? This is the price of the bond, isn't it right? That's the price of the bond, isn't it? Bond valuation, because this is the present value of all these coupon payments, right? Which is basically present value of annuities, right? And then present value of the last annuity and the present value of the face value. So sum of all these present values, that's the price of the bond. Okay, then by convexity formula, which is basically 1 over B, bond price times 1 plus y squared times the sum of all of this. Sum of all of this, that's this, isn't it right? Then we try that. Okay. You are dividing this by bond price times 1 plus yield squared. I need to put parentheses here. Otherwise, if you don't put parentheses, then G17 divided by E17 will go ahead. It will be that will be done first, and then it's going to be totally wrong. So make sure Excel would recognize this thing as the denominator. Okay, so hit enter. This is convexity. Okay. So I wonder if I got, let me just make sure. Convexity is relatively high. Remember, convexity is relatively high, and even in this example, right? And the higher the convexity, the better it is for, because what it means is the convexity in this example was 212, right? It's a very high convexity, and high convexity is good. Why? Remember, this curvature is not symmetrical. I mean, if it is, this is like 45 degrees. I mean, think about it. This is convex to the origin, right? So in other words, the axis would be like, it is against, this axis, right? In other words, I told you, that's why it is asymmetrical. I mean, vertically, it's asymmetrical vertically, right? If it is vertically symmetrical, then, high convexity doesn't necessarily mean, it isn't necessarily good. But high convexity means, for a same for the same amount of drop in the yield, the increase in price is much greater than for the drop in price for the same amount of change in, or for the same amount of change in, or for the same, what should I say, for the same increase in the yield, right? For the same amount of drop in the bond price, in the yield, the price increase is much greater than for the same, than the drop in price for the same amount of drop in yield, right? Same percentage of drop in yield. So that's why high convexity is good. So that wraps up everything about convexity. That wraps up everything about convexity, okay? Now, you're ready for the midterm 2, right? You're completely ready for midterm 2. All righty, any questions so far? Any questions? All right, if there are no more questions, then we're moving on to the next topic. And our next topic 4, is risk and return. Okay, you might have, this is something you also ran into in Finance 100, but we are going deeper. Okay, so let me close this. And of course, you need to download these 2 files, and all 3 files. Download all 3 files anyway. All 3 files. Okay. So we already know what return means. First of all, in Finance 100, the first thing you learned is holding period return. Holding period return is basically what? I don't need to, I'm not gonna go over this over and over because this is something we already did in the Finance 100. Basically, to rewrite this, if you took Finance 100 with me, you know already this. Price at time t minus price at time 0, or t minus 1, I would. Come on, that's an eraser. Okay. Or sometimes I represent it as price at time n price at time 0. However, you represent it, that's fine. Price at time. 0. Plus it's kind of, there isn't any undo here. All the cash flow, right? Is there an undo? You know, during the time period. And then divided by, okay? And we all know another name for this that's called capital gain. Okay, that's called, that's called capital gain. I'm sure you, I don't need to go over this. Yeah, and PT here, or PN, is the price that you sold that asset for. And PB is the price you paid, right, when you bought it. And of course, therefore that's initial investment. You can call that initial investment, right? Also, so initial investment. And this is actually, cash flow during the holding period. So it should be expressed as sum of, right, all the cash, if the cash flow is, on regular basis, right? And where, T runs from beginning, right? Time 0 to whatever N is, right? All right. And then, so return on investment, basically on multiple periods, so holding period can be, multiple. Holding period can be like, any number of years. N years or any, number of, it could be years or months or whatever, holding period. And if you held it for N years, of course, there are many, annual returns, right? Or if you held it for 1 year, and then there are 12 monthly returns, right? So how do we annualize? It's basically annualization of annualized holding period return. And in, Finance 100, especially if you took it with me, you learned it through with house value example. And I told you it has to be the geometric average because a simple average, it overstates, right? It's not a simple average is not for time series, okay? Simple average is not for time series. And what is a time series? Time series means, a longitudinal data, historical data, right? Not for time series. The geometric average, which is also, time weighted. Dollar weighted average. This is, uh, 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 this is for, a portfolio, especially, in other words, because you have multiple assets in the portfolio, right? They all have different weights, right? So basically, we are using, geometric average, and basically, the formula you learned. This is basically geometric average, right? So let's take a look at this mutual fund example, right? So I'm gonna, okay, go to, open this file, right? And when you open it, go to bottom tab, table 5.1. Okay. You can find it, right? I told you already. Mouse is acting. I told you to download all of these files, and if you have downloaded it, you need to open this. So do you have it in front of you?
Need someone to be.
Hmm? Do you have it in front of you? I heard someone say something, but do you have it in front of you? Hmm? I'll have, this is very easy. I mean, this is not a difficult.
Yes, Professor.
Okay, good, Reina, thank you. So someone replied, okay, Devin, okay. So let me go back to. So first of all, asset before, so let's say this is a something like a fund, right? A portfolio, mutual fund, and mutual funds, there is, a constant. There are open mutual funds and closed mutual funds. Closed funds, the net asset value. In case of closed funds, you don't allow so new inflow of funds. Starts at the if the original fund size was 10 million, it's you don't accept new fund. You just go on with that 10 million. But you can by the end it can be much lower. Net asset value can be lower or higher. But here, this is open fund. So that means, most funds are open fund. There's no reason you wouldn't welcome, new client money. There's no reason you wouldn't. So at the beginning, there was $1 million. And then there was, 1.1 1.1 million in the asset before net inflow. That means, the asset grew 10%, right? So basically, the holding period return is, we all know it's not a difficult thing. B5 minus B3 or B3, it will have to be 10%. But then after that, there was, net inflow of another 0.1 million. Okay, then asset at the end would be, of course, this plus this. Okay? And then here, so then asset at the beginning of the second quarter will be 1.2, and then asset before the net inflow is 1.5, and of course, we can already, do it like this, and asset at the end will be, I'll just drag it like this. Okay. Then everything will be already filled in. Check. Where is? So it's not it's not that impressive, something, this very, elementary. We got the, the right result. Okay, so this is basically, how you, a simple example of how the fund return is, holding period return is calculated. Okay, now next is dollar weighted average. And the net cash flow, we're only, at time 0, net cash flow is negative 1 million. Why negative 1 million? You might wonder, why negative 1 million? That means from the investor's perspective, this is a mutual fund. From the mutual fund's perspective, at the end of quarter one, there was an inflow of 1 million. But where did it come from? It came from the clients, the investors. So from the investor's perspective, net cash flow, that is outflow, cash outflow. Isn't that right? There was a cash outflow of 1 million that went into the mutual fund, right? So that's cash outflow, which is the cash inflow for the mutual fund. And then additional cash outflow. There was additional cash outflow of 0.1 million, right, from the clients or the investors, from the clients to the mutual fund. And every time there is a net cash inflow, there is a net cash outflow from the clients. Every time there is a net cash inflow into the mutual fund, there is a net cash outflow. If there is a net cash outflow, that means net cash inflow to the clients, and so on. And then we measure basically this is like net present value concept, net present value concept. Are we going to have we'll find net present value as well, but internal rate of return, we use IRR command, IRR. And what IRR is, internal rate of return, is just cash inflow, cash outflow, and what makes the left-hand side, which is the what makes the left-hand side, which is cash flow at time zero, equal to the right-hand side, and hit enter. Internal rate of return is 3.38. This is dollar weighted average. Now, finding that there is something missing to find net present value, because to find net present value, we need discount rate. No discount rate is given. So we'll just leave it at that. Okay. So everyone got the same result? I'm sure you did, because it's not, it's not a difficult thing at all. This is basically another way we find, I told you, geometric average. I told you this, where did I put it? I believe I wrote somewhere. Oh, yeah. You find geometric average this way. That's on the scenario one. I mean, if you took finance 100 with me from the house value example, you know what scenario one. Scenario one is where there is only capital gains, no additional income. In other words, in scenario one, if this is zero, then that's scenario one. If it is positive, that's scenario two. Now, if the cash flow is zero, then there is only capital gains. Only capital gains, right? So it's like zero coupon bond, right? Okay, but coupon bonds are scenario two. Coupon bonds are scenario two because there is no cash flow. Not only capital gains or capital loss, the scenario two. There is no additional cash flow. Now, but so in scenario two, you find the geometric average this way. Now, in the first quarter, 10%, second quarter, 25%, a third quarter, negative 20%, fourth quarter, 20%. In other words, this is what? The gross return. That's gross return. Isn't that right? Not net return. 1 plus R1, 1 plus R2, 1 plus R3, 1 plus R4. That's the gross return. So basically, if you multiply, the final result of this growth will be, the product of all these growth rates, gross growth rates, gross returns, right? And if we have an average, right? If you have a geometric average, right? In other words, if if R1, R2, R3, R4 are all the same, all equal, that means that's average, right? The only way all of these returns would be equal is when we found geometric average of that. If they are all geometric averages, then, and then if it is all geometric average, then the product of all uh, product of all these terms would be 1 plus rg to the fourth power, right? That's how you find. And then if you solve for if you solve for rg, right? That's the geometric average, right? So it's the product of where I runs from 1 through 4, right? Right? And then 1 over n. N is 4 in this case, right? And that's R. Okay. This is, this is a symbol for product, Greek character. Pi, P, product. So, investor earns larger cumulative return when high returns are earned. Okay, so this is just something to read, read up. So I think it is it's the right time to take a break. So let's take a 10-minute break and reconvene at like 10:40. Okay. All right. Let's take a 10-minute. Where is it? All right, we're back. We're back. So most of this is what what you already know, actually. Now where is it? Where did it go? Oh, here. Right. So basically, this is all about, why, geometric average is, used. And dollar weighted average return. And we already did this exercise. Dollar weighted average return in this example, is less than the time weighted average return because the portfolio returns are higher when less money was under management. Difference between return. Going back to, I believe I can close this, right? This one. And this one. I should save so I can use it later. Excuse me. As you can see, the return was higher. In this example, because when there was more money, I mean, this is when the money under management was the highest. But I mean, this is when the money under management was the highest. But then you had, lowest return, right? And then when the money under management was the lowest, you had high return. I mean, considering that money under management was, 1.25, but under management was not even 1 million. I mean, this is, this is, this is better. But again, the money under management is the result of, net inflow, net cash inflow from the previous quarters, right? Previous period. This is not under the control. This is not something, they can control. The fund manager is not under the control of fund manager, right? As long as it's an open fund, so the dollar weighted average is not, I mean, think about it. If it is in a closed fund, right, the base is the same, but the base in open fund, and the base changes every time, every quarter. So then this is not way of consistently measuring the performance of the fund manager, right? That's basically what it is saying. What was I? So geometric average was higher because, as it says, because the portfolio under returns were higher when less money was under management, right? Okay. Now, so how do we convert holding period return into annualized return? We're APR is the stated interest rate. We all know it's what if you go to the bank, we all know if APR is 6%, right? But that's not the same thing as APY, annual percentage yield. This is also something we did in Finance 100. Right? Which is, in other words, APY is also called effective annual rate. Because what causes this difference? It's all due to M. You know what M is? Compounding frequency per year, right? So the higher the compounding frequency. So here, actually, they use, N for, that notation changes. Can I move this? I normally, and because N, because normally, N is what? N is the total number of compounding, which is, T times M, right? M is the compounding frequency per year. N is number of, T is number of years. So if M is, suppose M is 4 or 12, what is that? If M is 12, that's monthly compounding. Then, if T is 10 years, right? Then total number of compounding will be 120, right? So that's what N is normally, right? But here in this book, only in this book, again, I wish there was an undo button here. There's no undo. Okay, so so here, this is M, right? Compounding frequency per year. So 1 plus EAR, which is basically APY, right? APY, annual percentage yield. It's 1 plus periodic rate raised to N. So this is something you already know. What is R? R is APR divided by compounding frequency. So if APR is 6%, right? And if compounding frequency is monthly, right? If M is 12, then this will be what? 0.5%, right? Monthly rate should be 0.5. And we all understand, so here, we all understand that, APR 6%, but under and let's say M, we have two different compounding frequency. Let's say APR 6% time 10 years. But under these scenarios, let's say first one, M, what if M was 1? What if M was 12? We all know, I mean, what this means is, okay, let me put it like this. First, M is 1. That's annual compounding. If M is 12, right? We know what difference it will make, right? Then R will be under scenario 1, right? R will be still, under scenario 1, N is still 6%, whereas, N will be, what am I doing? N will be still 10, and under scenario 1, right? N will be 120 under scenario 2, right? And R will be still 6%. R will be 0.5%, right? Okay, of course, then we'll have different future values, of course, right? Then if that's the case, then, the future value under scenario 1, right, will be whatever the principal is times 1.1, 1.06 raised to 10, right? And the future value under scenario 2, so hard. Under scenario 2 will be principal times 1.005 raised to 112, right? Everyone, this is, Finance 100 basics. So you really, and of course, you know, future value in the second case, second scenario is greater than the first. And the difference is resulting from the compounding factor, right? Because the compounding factor or the multiplier in this case is right, this, whereas the compounding factor in this case is this. And the maybe I don't even have to that looks you know lousy. So that makes the difference between you know APY and APR, right? So basically, you know, APY is in this case, right? APY, or also called EAR, is basically, you know, 1.005 raised to 12, right? Which is, you know, an APY in this case, in the first scenario, EAR, right? Effective rate, which is the same thing as APY, is simply, you know, 1.06 raised to 1. That's it, right? That's what makes the difference between, you know, APR and, you know, APY, or effective annual rate, right? Effective annual. And then, so we know APR is, you know, basically E1 plus EAR raised to 1 over n minus 1, right? Times n. I mean, this is basically solving it backwards, right? Mathematically, right? How do we get to APY or EAR? Maybe it's better to write here. We got to APY or EAR. Ah, what's happening? Over m raised to n minus 1. So let's say we are solving it for APR. If you solve this for APR, right? I don't think I need to do this, you know, step by step, but you know, I think it's everything, you know, for everything, math is very important. So, but you know, most of you can follow this, I believe, you know. So I need more space, so let me move this instead of rewriting it. Let me move it up. We need to solve this for APR, right? That's what I'm trying to say. And what do you need to do? So ignore, we'll just we'll ignore EAR, or rather, we'll ignore APY and just, think of EAR. So then, first of all, what do you need to do? You got to move this to the other side, right? So it's going to be 1 on the left-hand side. And on the right-hand side, we'll have something in the bracket raised to m, right? Then to open up, we cannot get to APR. APR is inside this parenthesis. We cannot get to APR without opening up this padlock, right? And the only way we can open up is by taking the mth root, not square root, but mth, because we don't know what m is, right? If it is 2, then it's square root. But if it is 3, if m is 3, it's, cubic root. If it is, 4, it's fourth radical or fourth root. If it is 5, fifth radical or fifth root. You understand? But we don't know what m is, so mth root, right? If it is, 12, 12th root or 12th radical. Meaning, you'll need to take the you all know square root of x, the same thing as, you have to write here to x raised to, right, half third root of x, another way of writing it, right, and so on. Nth root of x, right, x raised to 1 over n. And this is something, already treated in Finance 100. And also, this level of math, you should know. I mean, this is 300. I mean, this is already something, that you have mastered as a prerequisite. When you when you do something to the right-hand side of the equation, you have to do the same thing to the left-hand side of the equation. So that means that's what the equation is. I will have to raise it also to 1 over m. Okay? Then in the right-hand side, now, I'm sorry. What I did was, Jesus, what happened? So what you need to do is, because that was what was there originally, right? By raising it to 1 over m. Then inside the parenthesis, now these two cancel out. So this opens up. And inside the parenthesis, it was what? 1 plus APR over M, right? APR. And then now I can, I need to isolate APR, but there's no way you can do it directly. So first you will need to move this to the other side, right? In other words, transpose. So subtract 1 from both sides, right? In other words, so I have thing in the bracket, thing in the parenthesis, over M, the whole thing minus 1, right? Now in the right-hand side, it's going to be APR over M. Now, just to isolate APR, you divided APR by M and you got to this, right? It's basically currently I can't move that around, so I'll just erase it. So it's like now x equals z over y format, right? X equals z over y. So if you want to find z, what is it? X times y, right? So what do I do? I have to erase this again. So APR will be APR will be the whole thing in the thing in the bracket times M. Okay. So that's how you got there, right? And remember, the M is N here, right? The M I used is N here, right? Now, if I recover, what was in the, this is not. If I recall what was originally in this parenthesis, okay, that's exactly what. Okay, so that's actually these two are reverse processes of each other, reverse engineering. Usually you find APY or EAR, given APR, right? Given APR is given. If APR is given, you based on that given APR, you find EAR. You don't necessarily do. I mean, you don't do the reverse process. You don't do the reverse process to find APR from EAR, right? You don't do that very often. But if ever, yeah, this is how you do it. Okay. And I show the math behind it. Now, continuous compounding is what? Continuous compounding is, and this is also something we did in Finance 100. Requires, we need to use the Euler's number, right? How many of you have no idea about have never heard of Euler's number? How many of you? Please let me know. How many of you?
I've never heard of it, Professor.
Devin? Okay, who did you take Finance 100 with? Do you remember who you took Finance 100 with?
No, unfortunately, I do not remember.
You don't remember okay. But did you take Finance 100 at BMCC or somewhere else?
If I'm not mistaken, I took it at BMCC. I can double check and find out, like through Blackboard or something. But if I'm not mistaken, I took it at BMCC.
Oh, okay. I mean, but that was long time ago. I mean, unless you transferred into BMCC from some other school, right? But you're talking about Blackboard, so it must be within CUNY system. But anyway, I mean, if you took it somewhere else, or even if you had taken it at BMCC, in the syllabus that because I'm the coordinator of the finance program, if you, every faculty that teaches Finance 100 must follow my syllabus. But some adjuncts, I mean, all the adjuncts must follow. But then somehow there's no way I can supervise all of them, right? What they teach, there's no way I can supervise, monitor, and then I believe, most of them must have taught, Euler's number, natural log in Finance 100. It takes a lot of time. I mean, basically, other people, some may just, skim through these, topics on the syllabus, because it is really, unfeasible. To teach everything on it, it's unfeasible. We have only 14 weeks per semester. We meet only 3 hours per week. 3 hours times 14 weeks. Not enough time, not enough physical time. But I do, whatever, 14 weeks times 3 hours, right? Only 42 hours. I mean, one semester is supposed to be 45 hours. 45 hours. So it's supposed to be 15 weeks, but, with spring break or some, whatever, the official holidays, right? Official holidays, it, it drops to 14 weeks. So it is practically, impossible to cover everything there, but, at least they should give the best shot. I try to cover everything, and I do. And that's why I do it this way. I give you pre-assigned, all the lectures are pre-assigned so that you study in your own time. Otherwise, there's no way we can cover it within 14 weeks. And think about it. As I posted in the announcement today, after today, it's going to be spring break. The next time we meet will be on, April 23rd, right? From the 15th through 22nd, there's spring break. So the next time we meet will be this. So if we do it like this, there's no way we can. And then 23rd, 30th, 7th, how many more classes left? 14th. That's it. That's like 4 more classes left. There's no way. There's no way. There's no way we can cover everything on the syllabus. If you're taking a laid back attitude, if you're taking, classes, studying is only in class, and then if you don't study, in your own time, I don't have time for that. No, there's no way you can, do this. It's an all-out effort. You have to risk everything on it. All-out effort, right? There's no way you can. Some people think, oh, life comes first. I have to do this. I have children. I have this. I have family. Yeah, I know those are, but then everything is a choice. I mean, I graduated college in '83, but then I didn't start a family. I didn't meet a woman. I didn't get married. Or look, why? Because I had to achieve something. After graduating from college, the best thing. I had to get the best job. I mean, best job available at the time, in the 80s. Well, didn't pay enough. I mean, it paid enough just to support myself, but nothing to like. But anyway, so and then after working, in a large corporation for about 2 years, that wasn't, I see myself in a rut, right? I see myself in a rut. This is not what I want to become, because if I devote 20 years of my life into this, and 20 years later, I will probably, or 20, 30 years later, I will be promoted to like something like, by then I will have been promoted to senior vice president or whatever, or probably, there is a lot of hierarchy. There's a lot, huge, long vertical hierarchy in the corporate structure. So maybe 20 years later, and then I will have probably been retired. But 25 years later, maybe I'll have been retired by then, or 30 years later. But then what? In those days, maybe I will have a house in my name, still mortgage to pay, right? After retiring, then I will be just back. I will just a middle-aged man in the neighborhood. I mean, nothing to carry in front of my name as a title. Maybe the only title is X Senior Vice President of XYZ Corporation. It's X, right? Former Senior Vice President. But that doesn't make any difference. I mean, average Joe, an average Joe can still, open up his own business and, call himself the CEO of the one-man operation, right? So the title is really nothing, you open up a pizza shop, you are a CEO of that pizza shop, president of that pizza shop, right? So, and again, going through that corporate ladder, you need, more than bachelor's. So I had to go to graduate school. I went to graduate school, quit the job. I had to quit the job. I couldn't do the graduate school, while still holding on to a job. But that graduate degree, that master's degree, first master's degree I got wasn't um, the one I really wanted. I got it, but then I had to do another, graduate, another master's, and then I mean that led to eventually um, a PhD. But that was a long process, right? I got my PhD only when I was 39. But I was in and out of graduate school and in and out of jobs. Why? Well, because I had to, um, after graduate school, I had to get a job, because I depleted all my funds. I had to make money. Then, after amassing, accumulating, enough money, then I went back to graduate school and did another degree. But through all that time, it was a sacrifice. Think about it. You think, I didn't owe, I didn't own a car. I mean, after college, uh, in my 20s, I had a car, but I had to sell it. I didn't have a house in my name because I couldn't, afford. There was no way a graduate student would get a loan. But those things that should be put to later, right? And if you think you have to make this money and you have to um, if you have to support a family, yeah, that's your priority. What can you do? You'll have to, uh, but then that's why they are saying there's a time for everything. There's a time for studying, right? When you are young, when you're in your 20s, that's the time to study. And getting promoted, you won't be able to get promoted to like a senior management level in a large corporation, right? Without at least some type of graduate degree, like MBA or some master's degree in economics, finance, or physics, math, statistics. Of course, there can be other areas like marketing, human resources, but to be promoted to the um, to that senior management level, you need um, a graduate degree. But then, when you have a family, you have, or, you have more than yourself to support, that's really a distant dream. And as I said, it's a matter of making a choice. You can start a family later. You can get married later after becoming something. But, when you have a family already, or when you um, have these, responsibilities, um, you can't be in an all-out war, right? Because you have to fight the all-out war to support a family. That's why there's a saying, there's a time for everything. The studying, you study in your early years, right? When you are in your 20s or early 30s. If you're in your 40s, that's unless you are just by yourself, unless you're still a single, then you can fight an all-out war for that goal. Again, back to the. So if you think studying is not your priority, of course, then studies won't treat you as your priority as well. You can't get A if you don't treat your studies as your priority. And treating your studies as your priority is like fighting an all-out war. Because if it is your priority, you will study very hard. Out of your 24 hours, right? Probably about 12 to 16 hours will be devoted to studying. Then your study will treat you kindly with A. But if you dedicate not even 1 hour a day on the studies, there's no way you can expect the study will be reciprocated by the study. There's no way you will get an A. If you get barely B minus, then that's very fortunate. That's very lucky. With a very minimal effort, if you get B minus, I mean, look at the efficiency. Minimal effort, and you get still B minus. That's a very good return, right? So again, we have very limited time. You have to constantly study, right? That's why all the lecture videos are that's the main lecture. All the lecture videos have been released in advance so that you can study on your own, in your own time. And collaborate session is only a reflection and review. Okay? So that kind of, digressed. So I will have to, if you are not familiar with Euler's number, I believe there's something there excuse me, not here, but I put review of, where did I put the review of Finance 100? I'm sure I put it somewhere. If not here, then do this, because I also have Finance 100 on YouTube. So go to YouTube and look up. It's pretty much the same thing as the name of the playlist is CUNY BMCC FNB 100. Okay, look up this playlist, and then if you go there, you will see not that. That's all. Why is it all garbage there? Library. Oh yeah, sure. FNB 100, CUNY BMCC FNB 100, yeah. If you go there, there's a video about Euler's number, right? Please watch these, okay? Please watch this. these two videos. Okay. All righty. So I think this is a good time to take a break again. 11:34. So we'll reconvene at 11:45. Okay. Reconvene at 11:45. All right, we're back. We're back. So what happened? Suddenly I have a smaller number of people. Um, so um, returning to our discussion of um, now, um, continuous compounding means what? Um, you know, compounding frequency, right? Normally, you think compounding frequency is uh, a finite number. In other words, you think. So I'll have to move around. So here, once again, question about m, right? We all know m is the compounding frequency per year, right? So m can be basically 1, 2, 4, 12. I mean, everyone understands, right? What I'm talking about. 52, 365. But is that all? Now, one is what? Compounding once a year, annual compounding. Two, semi-annual, twice a year. Four, quarterly compounding, quarterly. 12, monthly compounding. 52, weekly compounding. 365, daily compounding, right? But, you might think daily compounding is the maximum. No, no. Think about it. Practically, they do practically for, because people in general, I mean, if you go to the bank and ask the uh, teller or the personal banker, I mean, tellers don't know, uh, tellers just follow their bank policy, nothing. Uh, you can become a teller without any advanced degree. I mean, just, with just a high school degree, with the high school diploma, you can still become a bank teller. Um, But the point, of course, the bank will still be very selective, just because they have they are just high school graduate. Not everyone can get hired. I mean, they will try to get the one who are very presentable and smart, and are very sensible. Um, Even if you have a bachelor's degree, if you are not, from the bank's perspective, if you're not a very uh, sensible, smart, and presentable person, you won't get even a teller job, right? But the idea is, you go to the bank, and usually personal bankers have at least, some college degree. Personal bankers, they basically, uh, give you a consultation about bank products, right? Their products. Usually, they will also serve as the private banker who will take care of, um, if you have investment account with them, uh, they will provide, uh, uh, some, advice about the financial uh, advice. They will provide financial advice. But just because you have an investment account, it doesn't necessarily mean that you will get very reliable. I mean, uh, uh, advice from them, because eventually they don't take responsibility. In all investing, you are ultimately the one that is responsible for your own decisions, investment decisions. So, uh, but anyway, the idea is, uh, for all practical purposes, they don't use anything beyond daily compounding, right? But but on a higher level, we have, compounding frequency that is, infinity. In other words, infinite compounding per year. I mean, infinite compounding. That's why this is all resulting in Euler's number, right? And they don't the bank people don't understand this. They don't know. Only in the bank's corporate headquarters, those who are mathematicians, in the research department, those who are mathematicians or economists, physicists, right? Those who have science degrees will understand what Euler's number is. But think about it. In the retail banking, in the branch, it's basically marketing job, isn't that right? It's marketing job. They want to get, of course, it's passive, uh, but they want to basically bring in more deposit into the bank, and they want to make more loans, right? More loans. That's the job. So it's a marketing job, basically bank tellers, they do very limited passive work because they take deposit and give you the money, when you make the withdrawal, right? You can do that from the ATM too, making a deposit and making withdrawal. You can do it from ATM too. So actually, that's why bank tellers, they are getting rid of bank tellers more and more, and instead the banks will have more uh, uh, the personal bankers. And personal bankers are what? They are, basically marketing position. They want to sell their product. They want to expand their client base, right? They sell products basically. They sell um, uh, CDs. They promote their CDs, their savings account, their so basically, but you go to these people and ask them, so can I get, hourly compounding? Can I get hourly compounding on my uh, deposit? They will say most likely no, but before that, in their mind, it doesn't even exist. Hourly compounding would be what? Then compounding frequency is 365. Oops, what happened? 365 times 24, and then minute compounding by the minute. Then of course 24 times 60, and compounding by the second. 365 times 24 times 60 squared. Then right, 60 times 60. Before, as I said, for all practical reasons, for all practical purposes, they don't use anything more than daily compounding. But again, in the research department, right? I mean, for not just the research department, the quants. I don't know if you've ever heard of quants, quantitative analysts. Um, these are the people, and if you study finance, ultimately, becoming a quant is just the natural outcome of studying finance. And on that level, you just deal with the mathematical models, and mathematically, um, the, the compounding frequency can be even infinity. I mean, as you increase the compounding frequency, what do you see? You are basically splitting time into infinitesimally small fragments, right? So, so if you don't understand, if you don't know where this, Euler's number comes from and how it is, how it is related to a natural law, you need to understand the logarithm as well. But we cannot repeat this at this point because, this is something you should have done already in Finance 100, right? And if you didn't do that, you need to make it up on your own, right? And as I said, I gave you already my Finance 100 YouTube channel name, so you go there and study on your own. Okay, you have to make it. So basically, if you take it to the extreme, if you take it to the compounding frequency of infinity, then you will arrive at Euler's number. So basically, literally continuous compounding means continuous. Compounding is done continuously. Now, think about it. These are all discrete compounding. I mean, daily compounding is still discrete. You understand? The time is the time we perceive time as discrete units, isn't it right? We perceive time as discrete units. By the second, 1 year is a discrete unit. Half year, discrete unit. Months, quarters, discrete unit. Even hour is a discrete unit of time. Second is also a discrete unit of time. Think about it. We measure time by seconds, minutes, hours, days. But even from 1 second to the next, time still continuously flows. Isn't that right? Time isn't frozen at 1 second and then the next second it moves again. No, it's not like that. Isn't that right? Everyone understands that. Although the clock, the second hand on the clock ticks, and the ticking of the second hand is like a discrete movement, right? From 1 second to the next, the second hand is frozen and then ticks the next second, and it's frozen again and then ticks. But this is only because we are measuring time in discrete units, but that's not the nature of time. The inherent nature of time is continuously flowing, right? Then how do we capture that continuous fluidity of time? The only way we can do it is by segmenting time into infinitely small fragments. And if we connect all of those dots, then we can emulate the fluidity of time. In other words, what I'm talking. So you guys are finance majors, so at least you understand what I'm talking about. It shouldn't be completely a foreign concept, because think about it. The return over time, right? If we plot annual returns, right? Annual returns, right? Let's say these are 1 years, right? Year 1, year 2, year 3, year 4, year 5, year 6, year 7, year 8. I mean, connect those dots. They will be all kinks like, they will have a lot of kinks like that. But if we break it down further, right? Break it down half year into 6 months, right? It will be smoother than that, right? Because we have, right? And if we break it down into quarters, it will be smoother. If you break it down into the month, it will be smoother. In other words, this curve will eventually become, and as you break down time into a smaller fragments, more and more it will become smoother. And eventually, if you break it down, we will probably be able to replicate the smooth fluidity, right? And this is not possible if we do not, if this won't be possible, if we do not break time into a smaller, finer, infinitesimally finer segments, right? What I'm trying to say is not even, it doesn't have to, it's not really, this flatter, but what I'm trying to show is, it will be much, right? And then it will be right? Eventually much smoother, right? Or even, we can get rid of, all these, awkward kinks from the graph. So that's why we need to stretch it to the limit, right? Where the n, the compounding frequency, is infinity, right? And then then we'll have to deal with natural log and Euler's number. So in a continuous compounding, right? The compounding factor or multiplier, compounding multiplier, right? 1 plus EAR will become Euler's number raised to APR. And if you solve this for APR, then just like we're solving, so they are, like reverse functions of each other, right? EAR, they're reverse functions. And the natural log of 1 plus EAR, okay, which is, then that this APR is called, continuously compounded return, right? And basically, natural log of E, Euler's number, is 1. Okay? And it's because natural log is log to base e. And if you raise it to log, I mean, if you take Euler's number, if you take the natural log of Euler's number, it's basically, it means, simply e raised to itself, 1, e raised to 1, Euler's number raised to 1. And when you take the log of, so think about it. Where do I? If you take screen now, so if you take base 10 log of 10, what is that? It's 1 because it's, 10 is 10 to itself, right? So the same thing. If you take natural log of Euler's number, in other words, base e log of Euler's number, it will have to be 1, right? That's basically the math behind it. And again, if you are not familiar with the math behind it, please study on your own in your own time. I gave you my Finance 100 YouTube channel, so please study that. And otherwise, we can't, you can't understand anything. You can't understand actually what's going on here, right? Continuously compounded return. This is an example of continuously compounded return. First of all, suppose this is, to make it simple, this is one period, right? PT minus 1, price at time. So let's say price at time t minus 1, something like last year, and PT this year, price at time t. Suppose there was, price last year, or you can call this, I can call this P0, price at time 0, and call this price at time 1. During 1 year, that was tenfold. The price jumped by 1,000%, tenfold, right? Then, but the net growth rate is 900% because capital gains is $900 only, right? This is gross, so this is basically gross return or gross growth rate, right? If you take the, this is actually not column E, column D, column D. So what's going on in column D? Column D is if you take log to base 10, common log, right? If you take log of 1,000 to base 10, right? And then here, this is log, okay, the same thing. So think about it. common log of 1,000, right? Common log of 1,000 is 3, because of course. What's going on? Oh, I'm showing because I'm. Right? Think about it. Base 10 log of 1,000 is 10 to the third power. And you know, log 10 to base 10 is 1 because, you know, uh, and then, oh, I should stop this. And then log of 100 to base 10 is 2, of course, right? And if you take the growth, if you take log of 1,000 over 100, which is 10, is 1, right? And in percentage, right? So this is basically, you know, it's not column E, it's column D, right? What this means is column D, right? Thing in the column D. 10 raised to, oh, not column, that was correct. Column E was correct. But, you know, instead of what I did here is, you know, if I this 3 over 2 is, you know, 3 minus 2, which is what? Actually, 3 minus 2 is 10, because 3 minus 2 means, you know, I have to write this again. 10 cubed divided by 10 squared, right? 1,000 divided by 1,000 divided by 100 is of course 10, which is, but you know, in the power, you know, exponents, right? If doing this is the same thing as doing this is the same thing as doing this, right? I don't have time to, you know, but you know, if you did finance 100 well, this is not a this is nothing new. The laws of, you know, exponents, right? So please, you know, I can't go over this. We just simply don't have time. And this is at least, you know, basic math. Required to understand at least this level of math is very basic to studying economics, finance, or science, any physics especially. And I guess we already like 5 minutes past our closing time. So please study on your own in your own time. Uh, my YouTube channel on Finance 100. Okay, alrighty. So if you have any questions, I will answer it. If you send me email, I will answer by email. Okay. Um, all right. So that's it for today. I will see you guys uh, after the spring break on April 23rd. So have a great afternoon and great weekend. All right. All
Thank
right.
you.
All right. You're welcome.
Have a good weekend, Professor.
All right. Great. Have a great afternoon. Robert, did you say you had a question? All righty. Maybe not. All righty. So stop recording.